Now, making millions of dollars on Wall Street may not be unusual, but this year a single trader at Goldman Sachs exceeded them all by earning more than $100 million on the bond market. Now, 34-year-old Tom Malafronte bought billions of dollars worth of junk corporate debt from clients anxious to sell on the cheap in January. He was gambling that prices would pick up. And when they did later in the year, Malafronte sold the debt to investors and pocketed the $100 million profit. Now, these risky big bets are harder to make nowadays, with new regulations being brought in after the recent financial crisis. Here's the view of an analyst who works in the City of London.
I think it's become a lot more stringent. I think one of the things which led to the financial crash and one of the things that created so much media attention following it was the lack of regulation within the banks and the amount of risk taking. With regards to this story today, though, I think this just goes to show there's only so much that the regulators can actually do when it comes to market making exercises within the banks. They have an obligation, specifically in these low liquid areas such as high yielding and junk corporate debt, to offer a service to their clients. And what this sometimes means is when they don't always have a buyer and a seller available, they have to take that risk onto their books in order to continue to provide a high quality service to their clients. Now, the amount of time they hold them on their books and how big a risk they take with these positions will depend on the internal procedures of the bank. And I think the regulators, while imposing stricter regulations on the banks, can do so much. I don't think they're ever going to impose such strict and specific guidelines on what exactly these certain banks can and can't do. And therefore, when you look at the story such as today, when you've seen these large gains made, people are always going to ask questions about whether this is market making and whether this is prop trading, which was banned following the financial crisis. And I guess it's going to be a very difficult question to answer as to which is which. I think it's always going to be easy for these larger banks to make such a high-risk trade on these specific desks. We've got to remember that the higher yielding, the higher risk areas, such as the high-yielding corporate debt, for example, in such a low-liquid market, they do have the potential to move quite dramatically, and therefore the potential for these higher gains or higher losses is always there. How much risk they take is not going to be down to the trader himself. It's going to be down. There's going to be a number of levels above the trader, depending on how high the risk becomes with regards to whether they can take on this risk and take on this trade. When it gets to a certain level, you would imagine there'd be compliance would be involved, and a number of different departments would be involved in order to ensure that they are sticking to within the guidelines of the bank itself and whether they can afford to take on such risk. But like I say, it's always extremely difficult to monitor because every bank will have its own guidelines and will have its own variances on how much risk it is willing to take on and how long it's willing to hold that risk for. I guess this is never going to be made a big issue of when the trades themselves or when the risk that they've taken on don't lead to big losses or gains. But when they do, as in this case, then it's going to attract a lot of scrutiny.